This is the week of Independence Day. In honor of this holiday and our God-given virtues, we have put in a photo of most of the Tower 68 crew. Notice the hats that we picked up at Beach City's church this last weekend. The hat emphasizes God Bless America and Psalm 33:12. Please take a moment and read this psalm. It is truer today than ever. Every week I try to point out, it's not the news that counts, it's the market's reaction to the news. And what's interesting is that unlike the wild volatility seen earlier this year on the tariff negotiation headlines, the market continued its quiet, calm action even as the Middle East and oil prices flared up. That fits into one of our main thoughts as we wrap up a volatile, news-driven first half of 2025, that the past 6 months, really going back to December, look like one big setup for the market. Also, the undeniable fact that the first quarter of the first term of first-year presidents always has a tough time of it. Every time for a different reason, but every time it has been the case. I have put in this graph numerous times in my weekly commentary, but I believe that providing it again is of great value for a backdrop of where we are currently. Another point to consider is that in the first quarter of a new administration, the equity markets tend to really have a tough time. As can be seen in the chart here, I have overlaid the 2025 market on top of the average market for every first year, going all the way back to 1928. January seems to be a bit of a honeymoon. February is when the new president tends to shake things up. March is a settling of the shakeup, and the first half tends to then be quite strong. Note the yellow arrow pointing to where we are today. Another important point is that this chart not only reflects a known historical consistency, but it also illustrates what could happen next, a time when the market might extend on a very strong run, higher beginning at the start of the third quarter. After a couple of very good years, the major indexes did great in both 2023 and 2024, while growth stocks enjoyed a big 15-month run. The market usually needs some sort of reset to hike the fear level and reload the cannon of buying pressures. This was a perfect reason that was consistent enough to really allow investors, both domestic and abroad, both institutional and individual, to sink their teeth into. Sometimes markets can re-engage after months of listlessness rather than outright decline, but this time we think that the past 6 months of topping, plunging, rallying back, and recently tightening up have been about. Who knew the U.S.-Iran-Israeli conflict, Trump's aggressive tariffs, a hawkish Federal Reserve, and the underperformance by the Magnificent Seven would push the stock market back toward record highs? As our past reports have been saying, global liquidity, that's who. And when I say global liquidity, I primarily mean domestic cash still sloshing around in short-term, highly liquid assets, looking for a home. I have been very surprised that this factoid has not been mentioned in the financial press, as it is sure to provide a huge source of capital for investment if opportunities are thought to exist. As of June 17th, this is where it is. Since the April 8th low, the rebound has been so sharp that investors who sold during President Trump's shocking initial tariffs revision on April 9th have missed out in a big way. The bullish overall setup is there, and we remain very optimistic that the market as a whole is on track for plenty of upside when looking out for many months. Still, there's been very little abnormal action, bad breakdowns, so the question has been when the buyers will start to really flex their muscle. And while it hasn't been overly decisive, and there's still some selling on strength out there, the good news is we saw some fresh strength this week, with more than a few names we watch or own coming under accumulation. I often like to take this thought and put it in perspective of past situations that the markets have digested and moved forward from since COVID. Unless there was a recession, there was always a V-shaped recovery in the markets, as I stated last month. There needs to be something structurally wrong for the markets to truly reflect in a major decline. Feels almost like a new bull market than a late cycle. The investment outlook is better today than it was in February at the old highs. The big bugaboo is tariffs, and visibility is much greater now. The markets have now survived their 5th major stress test. There have been 8 times that the S&P 500 has had similar corrections as it has since the 15 to 20% April of this year. This recovery has been the strongest of all 8. I believe that the reason why the advance was so strong and so sharp is that the reason for the initial decline was a combination of a typical calendar event in the first quarter of the first year of a new presidential term, coupled and catalyzed by an exogenous event of tariff scares. Since it was not precipitated by an economic decline, an inflation shock, a growth decline, or drastic interest rate hikes, it has had no effect on first quarter earnings or the expectations for second quarter earnings. It is becoming apparent that the next up leg will likely depend on the trajectory of earnings, the economy, tariffs, inflation, and Fed policy. Technical perspective, the breadth that was my concerns that I stated last week are seeming to alleviate themselves as we are seeing different sectors, namely financials, consumer discretionary, and industrials now joining the advance. This is tremendously important. Also, the smaller company index, the Russell 2000, is climbing back on its horse. This is a statement to resilience and continuation of strength revitalization in the smaller company space. With much of the news focused on Middle East developments, market volatility, and the Fed, Q1 earnings season never took center stage. Now that some of the dust appears to be settling, we take a closer look at the results, focusing on sector and company-specific drivers, revision trends, and key factors for earnings heading into the second half of the year. The 4 sectors with the highest Q1 beat rates were healthcare, 93.3%, communication services, 90.5%, technology, 89.6%, and industrials, 85.3%. In contrast, utilities, 58.1%, real estate, 64.5%, and energy, 68.2%. The sectors with the lowest beat rate higher in Q1 than prior 2 quarters rates also have much smaller weightings and less influence on the broad index. Rising concentration and growth sector dominance within the S&P 500 has left the index increasingly reliant on a handful of mega-cap names and industries to deliver growth. The dynamic has amplified the importance of sector-level earnings trends, as well as the potential risk if the mega-caps and growth sectors fail to live up to expectations. Looking forward to the second quarter's earnings, those showing expected contributions to 2025 earnings growth for the quarter are as follows. 7.1% of earnings growth expected from the S&P 500. Technology accounts for 4.1% points, making it the most important sector for earnings this year by a wide margin. Healthcare, communication services, and financials follow as the only other meaningful drivers of growth. Note that energy, consumer discretionary, consumer staples, and real estate are excluded, as all 4 sectors are expected to see earnings contract in 2025. This is our expectation based on the forecasts that were provided by the index constituents at their announcement of Q1 earnings. So this is where we are sitting currently as of last Friday. Since last Friday, the numbers have gotten even better. So much better, in fact, the market keeps pushing the ceiling to new highs. Going back to 1929 and looking at every V-bottom, it can be seen that the only time that a V-bottom did not occur from a waterfall decline, there needed to be a recession present. Not only is the market saying that there is no recession present, but the Fed has remained stubborn in their further loosening of interest rates since there are no economic data points to support a continuation of rate cutting. Here is a picture of all 12 V-bottoms with an indication of which ones were accompanied by a recession. So what is really going on then? Markets are at new all-time highs, and yet there seems to be no fireworks at all. I basically see the following as major reasons why many are not only in disbelief, but also, if they were to change, there could be a serious acceleration to the upside. Non-US investors are not bullish because they have Trump derangement syndrome. This is tough to quantify other than the action of the US dollar and the movement from US equities into world ex-US equities. As I mentioned last week, the S&P versus the world example US is starting to show the US developing a head of steam once again. If these foreign investors should jump back on the U.S. bandwagon, this could be additional firepower to the $7.2 trillion mentioned above. Institutional investors are not only not bullish, but they are actually shorting stocks. They are even adding to their shorts on a weekly basis. To reverse this, a short squeeze could result, and there would be another block of purchasing sending markets higher. High net worth investors are not even bullish. This was validated in the AAII, American Association of Individual Investor, Sentiment Poll survey for this last week. There are still more bears than bulls in high net worth land. In closing, even veteran economist David Rosenberg, who typically leans bearish, said the technical setup has also improved in recent weeks, supporting a spring-summer rally. While this cannot exactly be described as a rally based on the fundamentals, Rosenberg said, the technical picture has improved considerably as the gaps get filled with ease and the cumulative daily advance decline lines for both the New York Stock Exchange All-Issue Composite and the S&P 500 make fresh all-time highs. Nevertheless, valuations remain stretched near levels seen at the peak of the dot-com bubble, based on forward earnings estimates, but history shows that overvalued leading names often become even more overvalued, especially during bull markets. Further, AI's exponential growth is doubling every 3.5 months in processing power, so it continues to be underestimated despite the hype. Plus, AI is rendering debt-based business models obsolete. AI-driven companies like OpenAI and Anthropic achieved massive valuations without borrowing, a shift from historical norms where debt fueled scalability, such as in shipping and railroads. Finally, historical data shows that buying stocks at all-time highs can generate slightly better returns versus buying at any other time. As always, please contact us if we may be of assistance.